Hey guys, Aaron from EK Financial Group here, and I've got a portfolio update for you guys. I've got Andrew McKie, one of the founders from Elston Asset Management. If you remember, these guys constructed and managed our Weinberg portfolios for you guys, and lucky enough to have Andrew here in the office at EK headquarters, and I'm going to ask him some questions about the markets and how the portfolios have been stacking up. So Andrew, first of all, mate, let's talk broadly about the markets. How are both the Australian and global market positioned at the moment? What's been happening?
Yeah, probably all about inflation outlook and interest rate outlook, really. If you look at domestically, it's certainly that story. Reserve banks obviously started cutting rates. We've seen cost of living pressures that have come off a bit of pretty elevated levels last few years. And so the outlook really is about direction of interest rates and then obviously what that means in terms of sectors and how that sort of broadly affects the economy. Fed's the similar story, so pretty soft inflation numbers coming out of the US. We're seeing some sort of hard data and some of the results as well, where we've got Australian businesses with US operations that are pretty weak as well. So we think the direction interest rates is down. That's probably the main sort of theme driving markets at the moment.
Okay, cool, thank you. Now we've just come out of the August reporting season here in Australia. So tell us, what did Elston learn, and were there any surprises to you guys?
There was a few things that came out of that season for us. One, that the domestically focused Australian companies actually did pretty well. The ones that had US operations were quite weak. They weren't just the ones in our portfolios, it's a broader thematic across the board. So, yeah, domestic strong, US weak. And probably the third dynamic would have been margins. So we're starting to see some of that investment in tech, automation come through. Businesses, even though if their top line might be a bit soft in terms of revenue, they're actually managing margins really well and starting to get that operating leverage from technology investment. So that productivity from technology is coming through in a lot of the results. So margins were a surprise across the board.
Yep. Okay. And did you see that interest rates, the recent interest rates drop in the Australian market, has that had a flow-on effect into these big companies?
Not so much yet, I think, because it's a little bit, looking at the rearview mirror. So we're seeing some early data come through. So if you look at Australia's consumer sentiment has bounced really strongly after 12 months or on 12 months. And if you look at things like cohorts, so during the sort of rising interest rate environment, it was that 30 to 45-year-old cohort that was getting really hit hard with higher interest rates and also cost of living pressures. That's moderated considerably for that sort of broader cohort. So we're seeing that they've shifted from just spending on essentials to actually increasing their expenditure on discretionary items and drawing down on savings to actually saving again. So those first signs of interest rate sensitivity coming through, and that for us is about then positioning going forward, what companies would benefit from that, what sectors would typically benefit from that. So it's the forward-looking positioning of the domestic portfolio.
Okay, so thinking about what my clients are thinking, so that cohort, I'm in that cohort.
Yep.
So I've got a mortgage.
Yeah.
It's not too small. So exactly right. Like interest rates are up. Me and my family probably aren't doing as much things as we want to. So like travel as an example.
Yep.
Buying those extra items we don't need.
Yep.
So to put into context of a mum and dad investor, that means that me and my friends are going to spend more money on extra things. So maybe we're going to go take a flight somewhere, go on a holiday.
Yep.
And then that's then going to flow into the economy back to these companies to help elevate prices and share prices. Is that how it naturally works?
Yeah, and I think interest rates in Australia, the old system used to be that, you'd cut rates and that would stimulate the economy. You'd put up rates to slow down the economy. But it's not as simple as that now. And the reason for that is the big cohort of baby boomers and also surplus assets in superannuation. So what we actually saw when interest rates went up, although that cohort, your cohort, if you like, that 30 to 45-year-old got hit really hard. They were the sort of RBA whack-a-mole, getting hit on the head with high rates. If you look at the 60-plus cohort, they actually did really well. So they had higher incomes coming through on obviously their cash and fixed income. Portfolios are doing well. If that rental properties, rents were going up with inflation as well. So they were spending more and saving more. So even though rates are coming down, it'll have an effect on cohorts differently as well. So you might see that cohort actually spend a bit less for example. And then, some improvement in discretionary spending for the younger cohort have been hit pretty hard.
Okay.
So, it's not as clear. It's more about maybe what companies, what areas would that cohort spend money on, as an example. But there are, it's a pretty simple story still in terms of rate cuts in Australia. You're going to see something in terms of housing. Obviously, we're still seeing pretty strong housing market, but in terms of demand for, say, new homes. So, property is an area that we're looking at as well, because they've had a difficult time with higher rates. Whereas we're starting to get some early data coming through for businesses like Stockland on new home sales, and even cap rates on, say, office, things like that improving. So that's an area, it's an obvious area that's of sensitivity to rate cuts.
Okay, cool. Thanks for the explanation. So based on all that, the data you've got, what you've seen happen in the last 12 months, what would you expect over the next 12 months in Australia?
Yeah, so we're doing a bit of that work right now. So we're looking at the companies in the portfolio that are sensitive to interest rate cuts, but also companies we don't own in the ASX 100 that are sensitive to interest rate cuts as well. So that's a theme. The other big theme that drove performance last year was the index. If you look at the concentration of our index, there was a lot of money flowing into the sort of top 10 of the index, as we had, reasonably mediocre growth. And also you had the trade situation globally. So there was a focus on domestic certainty, companies that are growing perhaps without the economy growing. They might be taking market share, those sorts of things. But you saw more of a focus on domestic sort of safe havens and blue chips, and that's run pretty hard. So if we looked at it, that's probably not where we'd see any opportunity in that larger part of the market, the sort of top end.
And when you're saying larger part, just to put it clear, you're talking banks, mines, so resources and banking in Australia.
Yep,
covers pretty much the top 10.
Yep, correct.
Yeah. Okay.
So they're having a lot of earnings growth, and you're paying record valuations for those businesses at the moment. So that's not where the opportunity is, but outside of that, there's plenty.
Okay, cool. No worries. Speaking of opportunity, which you just mentioned, so how is the portfolio currently positioned to manage one risk, but also opportunities moving forward?
Yeah, well, we're avoiding that risk in the index. Australia, if you look at buying an index fund, what is an index? It's just a way of providing an average return for what did the market do type question. And how you build that index is by size. The biggest companies get the biggest weighting in that index. And so a lot of money is flowing into that part of the market. And so where we're positioned is sort of X that. Some of those stocks we do own, but we've really dialed back our exposure there because of the overvaluation that's occurred within that. And so we certainly think that's not where the opportunity is, it's elsewhere. So that's what we've positioned for. And if you look at the overall portfolio versus that index, we've got better valuations than the index. We've got better earnings growth than the index, higher dividend yields than the index, and better diversification. You're not all, like you said, you're not all of your eggs in maybe two baskets, resources and banking. If you look at the top 10, you've got the 4 banks plus Macquarie, just 5 businesses alone. So, you gain more diversification, more risk management, and better valuations and better earnings growth. So it's a pretty simple story for us going forward.
Okay, cool. Thank you. Probably a harder question now.
Yeah.
So obviously focusing on the large cap portfolio, so the direct equities that you guys manage, and which is in our clients' Weinberg portfolios as well.
Yeah.
I want to hear some good, the bad, the ugly. So tell us, over the last 12 months, what kind of really surprised you? What was a bad detractor from the portfolio? So who performed really bad, which companies? And Ben, give me a good news story too, and who really shot the lights out.
Yeah, I think the more recent reporting season was definitely James Hardie. James Hardie's been a little bit on the nose for a number of reasons. They made an acquisition in the US as well that wasn't well received. For us, that was quite a good acquisition, and we've done a lot of work in talking to James Hardie customers in the US, and they think that is also a good acquisition for them. But they've been hit really hard with the slowdown in housing in that Sunbelt region, which is that sort of Texas, Houston region, and they're not the only one. Reese Plumbing, a good, Victorian firm. I think they started here. They've got big operations in the Sunbelt region as well. Reece Plumbing stores over there, and they've also had it really tough as well as Reliance Worldwide, a number of others. So it's for us, that's a macro thing. But if a stock falls like that, we're forced to review that thesis. Are we comfortable with that business still? Does the valuation still stack up? Is it something that's getting too hard? Do we move on to something else? So we've reviewed that whole thematic with James Hardie, and we do think it's a cyclical thing, not a structural issue with that business. So if anything, it's the returns are a lot more attractive where it is now from where it was. But that was definitely a disappointment. Probably more dramatic drop off in sales for them in this last quarter than the whole market was expecting. In terms of a really good performance for the year, was definitely Challenger. I think it was up 40% for the year. We looked at Challenger originally because of rising interest rates, and Challenger have 90% market share in annuities. Now, if you go look at an annuity and it's say for a lifetime and you're getting 1%, it's reasonably unattractive. But if rates go up and they're able to offer annuity, say at 5 or 6% guaranteed, that's a lot more attractive. So we saw that the demand for annuities would increase as rates increased, and that's certainly what's happened. And we also see a demographic shift there as more baby boomers come through. They need more income security, and so demand for annuities is also underpinned by that demographic shift. And then thirdly, we've got government really supporting that as well. They want to have the industry develop income products, retirement income products. And so Challenge is well positioned for that. So, we think not only has it performed well, but it will continue to grow its earnings and is well positioned to perform from here as well, given those overall thematics.
Okay, so would you expect from your holdings, which ones do you reckon will really outperform in the next 12 months? And what kind of thesis are behind them with the investment for you guys?
Yeah, I think probably a standout for us has only been a reasonably recent purchase, and that's Seek. And I mean, all your clients would know Seek reasonably well, the online platform for job advertising. We like Seek because of the simplicity in that business. So we've had new management come in Narav, who used to run Commonwealth Banks, come into that business and simplified it. They've got a dominant position domestically in Australia, but also in Asia. And they're now running both of those businesses on the one technology stack, so it's a lot more efficient for them. They're also implementing a lot of AI technology for both hirers, but also candidates. So what we're finding is that hirers are getting better value out of using Seek. They're getting better matching for the type of candidates. They're getting registration on candidates so they know validation of qualifications, things like that. So we're seeing the value go up, and Seek's benefiting from pricing increasing as hirers see that is a great alternative to say using a recruiter, for example. So they're able to put prices up and at the same time reduce costs. So we've seen margins do really well. The third thing, and why it may do really well from this point on, we're seeing that earnings growth come through at a time when private sector job growth has actually been pretty mediocre. A lot of job growth in Australia has been public sector, not privates. But with interest rates coming down, that typically means there's a bit more confidence around to hire. And so if we see any movement in job volumes, the number of ads that go on the Seek platform, one, they've got the pricing power, they've got the market share, they've obviously got costs under control, and then they also have an increase in volumes. We think that there'll be really strong profit growth from that business as well.
Awesome, thank you. It's good to understand the mind, I guess, of how you pick stocks and behind the scenes, so my clients can understand that too, and why a particular stock gets put in the portfolio.
Yeah,
so that's good to know.
Yeah.
Well, Andrew, thanks for your time today.
Yeah, thanks very much, Aaron, for having me here. It's really great to be here in the flesh, but also part of the whole Elston team. There's 100 people back in Brisbane diligently working away behind the scenes. But I just wanted to say thank you for your support, but also for your client support on behalf of that team. So thanks very much for having me. Thanks, Aaron.
So guys, if you've got any questions about your portfolios, obviously know that we're taking care of you. We've got Elston here on our side to help with that as well. And hopefully I will get some more videos out to you next quarter. Speak soon.